But hasn't that been the case all year? I mean, because in January of this year, the market was implying 6 or 7 cuts. We're only getting a few. We've slowed the pace. The 2-year yield is not that far below Fed funds anymore. So I guess my point is the market's already kind of registered that slower is better.
That's right. I think it's, I would just say it's not a consensus accepted view because, for instance, when Fed Chair Powell spoke about taking things a little slower, the market got weak and then maybe had a rethink. So I think it's going to take a while until markets realize one cut next year is actually quite bullish.
Tom Lee discusses the shift in market sentiment regarding Federal Reserve rate cuts, predicting that fewer cuts in 2025 will be seen as positive, extending the period of low rate. While stocks are currently richly priced, he believes an 8 to 10% return in 2025 is a reasonable expectation. He cautions against missing out on market gains, as staying in cash over the past 2 years would have led to missed opportunities. Lee also highlights the challenges in the healthcare sector, which was the worst performing in 2024. He expects policy changes in 2025 could bring both risks and rewards, advising a selective approach to healthcare investments due to potential regulatory shift.
I think there's a conceptual change that the market has to get used to, which is, let's say earlier this year when the Fed started cutting, people thought, oh, 5 cuts is good for stocks in 2025. So if the number gets reduced, it's bearish. I think as we get into 2025, the market's going to shift to thinking the fewest cuts possible next year is the best case because it elongates the dovish cycle. So I think we have to flip the script, but it's going to take some time.
So, Gene, kick things off. What do you think we learned this week?
Kelly, I think we learned a lot. I think we learned a lot in terms of the sustainability of the AI infrastructure trade. Of course, Broadcom focuses on custom silicon, which is different than Nvidia's GPUs, but the storyline that this is going to run out, the AI infrastructure is going to dramatically slow next year, essentially a strong data point that this is going to be growing faster for longer. And just want to quickly put some numbers around that, is that if you take Broadcom's 2027 guidance, which is remarkable that they're stretching out that far, but 2027 guidance, it basically implies about 60% annual growth. Right now, investors are expecting Nvidia to grow in 2026 at around 21%. And so I think that that's one piece that we learned this week. The second is that the pace of AI innovation continues to be rapid, of course, with Google coming out with Gemini 2.0. And so this is a big week for AI.
Steve, would you differentiate for us between Nvidia on the one hand and Broadcom on the other, and why people have become so currently excited with Broadcom? The numbers, the earnings, the report this week, good.
Right.
Not kick-ass great, but
well, there was
good.
also this report earlier in the week that Broadcom's working with Apple now to help them do some artificial intelligence chips. So it's a different, yes, to your point, NVIDIA makes those GPUs, they're more expensive, but Broadcom has become this player that companies go to. Google, by the way, is using Broadcom to make their artificial intelligence chips as well. Now, reportedly, Apple is getting in on that as well. That makes it really exciting. And these are, of course, the ones that run in the servers for training their AI models. What's really interesting about Apple, at least what we've learned so far, what they've publicly disclosed so far, they've been using these alternative chips to train their Apple Intelligence stuff. They've been using chips from Amazon. They've been using chips from Google, which, by the way, like I said, Broadcom has a hand in helping make those. What they haven't been doing is running out there like Microsoft and Meta have been doing, and Google to some extent, buying up gobs and gobs and gobs of NVIDIA chips and putting them in a server farm somewhere and training their AI models. They've been renting these other alternative chips. That doesn't mean they're not using NVIDIA, but it does mean, at least what they publicly disclosed, they're looking at these alternatives, and it's pretty impressive. They've been able to do this and launch Apple Intelligence in the way they have without spending as much as some of the rivals have.
I mean, we're going to do an amazing year. Are we too expensive now, or are we all right?
Well, it's tough to follow back-to-back 25% plus years, right? If we hold up to the end of the year. I mean, I think we got really close in the 1950s and the mid-70s, but I don't remember the last time we had back-to-back years for the S&P 500, which were 25% plus years. So if nothing else coming off that high, it's going to be tough to continue in that momentum. So I think that's got to be kept in the equation somewhere.
Would you call the market overpriced, overvalued, or how would you assess it?
Yeah. I'd come down right in the middle. It is richly priced, but it's not bubble territory. I know people compare it to the late 90s. Now, here's the way I think about it. Am I going to sell everything and head for the hills? No, it's not that kind of market. Am I going to take every dollar of cash I have and throw it in the market? Not that kind of market either. So if I have cash, I might be a little more reluctant to put that cash to work in the market right away. But if nothing else, the last 2 years should tell us the cost of not being in the market. People sometimes ignore it when they think about being conservative and not going into markets. But you'd have given up 60% upside in the last 2 years by staying in cash. That's a lot to try to get back by market timing.
What do you make of the argument, as I brought up earlier, that you may not be able to get any more multiple expansion in 2025, but you could still get a good return next year because you're going to get better earnings growth than what was anticipated, in much respect because of the policies that are going to be introduced by this new administration. You buy that?
You know what? I'll take 8 to 10% returns after the last 2 years. That would be good enough for me. I'm not trying to get rich in the market. I just want to preserve and grow my wealth. So I'm not looking even for double-digit returns. If I make 8 to 10, that's good enough.
Interesting. You know, when you look at the way that some of the AI-related trades have gone, when you look at the idea that, you know, the Nasdaq's had a bit of a resurgence, obviously. Right. You know, we got to 20K for the first time ever. Are you surprised by that? Did you figure that this broadening that had finally, you know, showed up was going to last longer? Or how do you assess that?
Not really. I mean, if you think about it, tech collectively, if you don't count the Mag 7, is up about 31%. And the market's up 25, 26%. That's where you'd expect tech to fall. So by itself, it's not like tech is taking off on its own. And the segment of technology, which is AI-driven, is a very, very small segment of the overall tech sector. So I think that the AI architecture part, obviously, the chips, the cloud storage business have taken off. But the AI product and service, market's being pretty cautious about, you know, piling into those stocks because until you can show me you can monetize those products and services, I'm not jumping in.
Well, what do you make of the outperformance of software versus chips? I mean, it's been pretty dramatic over the last few months. What's the signal?
I mean, I think that the architecture market has gotten ahead of itself. I mean, we've had, Nvidia alone had $2 trillion in market cap in the last year and a half. I mean, at some point, you got to stop and say, you're building all this architecture. What are you going to use the architecture for? So the next phase of AI is, I think, the use of the architecture, whether it's software, the products and services that emerge. So that's what I'd be looking for if I'm looking in the AI space, is converting that architecture to actually making money off that architecture.
I think we're trying to, you know, take a look at what this new administration is going to bring, what deregulation and tax cuts are going to mean. DOGE, the Department of Government Efficiency, what that is going to mean. I know you have one sector square on your mind today beyond tech, and that is healthcare. Why so much, and how much does the recent debate, this growing discourse that's around the idea of health coverage, the cost of it, the companies that are in the center of that public storm?
No, I define a bad business as a business where nobody's happy. The producers are not happy, the consumers are not happy, the government is not happy. And if you use that definition, healthcare is in trouble. It was the worst performing sector of 2024. So the market's also already leading into 2025 with lots of questions. And I have a feeling that this might be that very strange moment in time where both sides, you know, Democrats and Republicans, decide that something needs to be done, and if that's the case, you're going to see pharmaceutical companies and, you know, insurance companies in the eye of the storm. So to me, that's where you're going to see a lot of action in 2025. Doesn't make it a bad sector, but I think you've got to be picky about where you invest.
You feel like, as it relates to that the goalposts clearly have moved?
I absolutely do. I mean, I can't find a single person who will defend healthcare as offered today in the U.S. We're at almost 20% of GDP is spent on healthcare, and the outcomes don't reflect that spending. Clearly, something needs to change. And I think that's a consensus. And once that's a consensus, there is going to be action. And that's why I think in 2025, I wouldn't be surprised if you saw some major actions on healthcare. I don't know what they are, but they will affect the profitability and value of these businesses.
Would you stay away from all of those stocks as a result?
I don't have the luxury. I already have 4 of them in my portfolio. The question you got to face is, including United Healthcare.
Would you sell it?
I did sell half of my United Healthcare leading into 2025. Again, it's not a signal that I think it's overvalued, but it's done well for me in my portfolio. But at this stage, I think that there is a reckoning coming, and I'm worried about what United Healthcare and other companies like it will feel as a consequence.
I just want to make sure I got this correct. You've sold half of it since the incident here in Manhattan?
Yes.
Okay. Professor, I appreciate your time. Thank you very much. We'll talk to you soon.
In conclusion, Tom Lee believes that in 2025, the market will see fewer rate cuts as a positive sign, extending the low-rate cycle. While stocks are currently expensive, he considers a modest 8 to 10% return in 2025 a solid outcome, advising against holding too much cash and missing out on potential gains. Lee also highlights challenges in the healthcare sector, anticipating regulatory changes in 2025 that could create opportunities, though he advises selective investments due to uncertainty in the sector. Investors should approach with caution but be ready to adapt to shifts in policy. How will fewer rate cuts in 2025 affect your investment approach? Which healthcare companies or strategies do you think will benefit from potential regulatory changes?